Hello and welcome to another Lincoln property blog, brought to you by Walters of Lincoln. So this week I want to discuss how, if I had £140,000 to invest, is a Lincoln rental property still worth the risk? Rents in the Lincoln area have soared in the last 2 years, with the average Lincoln rent increasing to £798 a month, an increase of 16.3%. So if asked, we have recently inherited £140,000. We have contemplated purchasing a Lincoln buy-to-let property to support our early retirement. Considering that the Skipton Building Society offers a 4.25% return on their 18-month bond and the stagnant Lincoln property market, we are uncertain whether investing in a rental property is worth the trouble. Mr. and Mrs. A from Lincoln. Dear Mr. and Mrs. A from Lincoln, if your primary objective is to generate income and reducing your workload, buying a buy-to-let property is likely not the favorable option unless you leverage the purchase. Let me explain. The Skipton Building Society 4.25% bond would provide you with an income of £6,300 annually. Excluding the initial setup costs of solicitors and stamp duty, for £140,000 you can buy a Victorian 2-bed terraced house, which would rent for around £750 per month, or £9,000 per annum, meaning a return of 6.43%. Yet, when you rent a property, you need to allow for management fees and maintenance, so the return would be £7,650 per annum, or yield an equivalent rate of return of 5.46%. So it hardly seems worth all the hassle for an extra £112.50 per month with a buy-to-let property, compared to the bond. However, by using a 75% interest-only mortgage on a 2-year fixed deal at 3.94% with Mortgage Works on the same Lincoln home, i.e. leveraging, even at today's higher interest rates, the return on the 25% cash invested, £35,000 increases to 10.04%. If you bought 3 properties, you would use 3/4 of your inheritance to buy the 3 properties with 75% mortgages. The monetary return after the mortgage payments would be £10,539 per annum, leaving you £35,000 to more than cover the stamp duty and legal costs. If you had the cash to cover the stamp duty and legal costs, your return would rise to £14,052 annually if you bought 4 homes. Is this return sufficiently higher than your 4.25% threshold to make it worthwhile? However, most Lincoln landlords are primarily motivated by the potential for long-term capital growth rather than rental income. You mentioned the current Lincoln market is stagnant, yet as I stated several times in my Lincoln property blog, house prices have upturned recently, and rents have risen like a rocket in the last couple of years. Of course, there is a risk of house prices declining significantly since interest rates are rising, and we have world events that could change things. However, historically, Lincoln property prices have generally outpaced inflation on average by 2.4% per annum since 1975, something a savings bond can never do. That means that 2.4% needs to be added to the yield for the rent to give you the true return on your rental investment. Therefore, with an asset that retains its value in real terms, a rental income stream that does the same, and a depreciating debt, the long-term potential of the Lincoln buy-to-let properties appears more enticing. However, it is essential to note that property values can experience sudden and significant short-term declines, but if you aren't selling, that doesn't matter. If your aim is to contribute to early retirement, you will need to invest your £140,000. Cash is suitable as a short-term option, but it won't preserve your purchasing power as time passes. To generate a real return, you must invest that cash, whether in property, a carefully selected portfolio of stocks, gold, or another investment avenue. There is no definitive answer, and seeking advice may be beneficial, but ultimately, the best investment aligns with your comfort level. The simple fact is that the country is not building enough homes for the people who live here, the people who are living longer, and the 600,000 plus net immigration we are experiencing. If you are playing the long game, with great advice from an agent, and do your homework, it could be for you. If you would like any thoughts on this, do not hesitate to reach out and have a chat. P.S. As with all investments, all income will attract taxation. It would be best to chat with an accountant about that.